Hey, thanks for making it to Veterans Info Tap. I'm glad you made it. Hey, look, could we be expecting a rise in inflation these next 3 months? Look, July, August, September are the critical months for us with regard to COLA, cost of living adjustments. Now, those 3 months are the 3 months that are utilized by the Social Security Administration to figure out what the COLA, cost of living adjustment, will be for the upcoming year, in this case, 2024. Now, we've waited a long time to get here, and coming out August 10th is going to be the numbers for July, the first month it's being used. And there are some reports that are coming out that it might not be as shiny as what some folks may have thought. And in this case, bad news is kind of good news. It's a weird double-edged sword, right? The worse off things are as far as inflation and the costs of things, the higher your COLA will be, which is nice, but all it's doing is washing at best. A lot of times it will be short of the actual costs. However, still want to jump into this and share with you because this article that I found points to a few things. I'll give you some insights and I'll give you the little summary there as well regarding some of the insights here on July's numbers and what the potential may look like. We may be seeing a higher increase is the bottom line than what we had originally predicted, right? So the original predictions over the last several months have been anywhere between maybe a 2.7 to a 3.1 or 3.2% increase to your Social Security, dependency indemnity compensation, VA disability compensation, those types of stuff. So you will be seeing an increase. It's just, what's that number going to be? And is it going to still stay around that 3%? Because remember, those numbers were based on just months that don't count as far as the actual COLA numbers that they're going to utilize the months for, the CPI numbers rather, of the months that they're going to use, which again is July, August, September, which is the last quarter of the fiscal year. So with that, I'm going to go ahead and jump into this article. Please hit the like. Doesn't cost you a nickel. I really appreciate it. Subscribe if you haven't. I really appreciate it. It helps push this information out. And if you're not a member, consider joining. It helps the channel. And the little marquee next to your name helps me identify you in the comments so I can try to respond as promptly as possible. So jumping into it, wanted to read this article to you on a website called Seeking Alpha. And the headline of the article is July CPI report may hand the market a harsh dose of reality. So here we go. Jumping into it, the CPI reading on August 10th, which is coming up in a few days, may carry more importance than markets are letting on. As noted last month, the June CPI report was the easiest print of the cycle and likely marked the end of the stock market's fantasy of inflation magically falling back to 2%. At least not anytime soon. Analysts expect the CPI to rise by 3.3% year over year in July and up 0.3% month over month, up from June's reading of 3% year over year and 0.2% month over month. So seeing some spikes here is the projection, right? Core CPI is expected to rise by 4.8% year over year and 0.2% month over month, both in line with June. Inflation swaps are currently pricing July headline inflation at 3.2%, a reasonably steady view from the swaps market since the end of May. Rising energy prices. Gasoline prices rose dramatically in July. Not sure if you noticed it or not, but I did. As the average price for unleaded gasoline rose by 6.84%, the biggest gain in gasoline prices since January. Rising gasoline prices may not present much risk to the July report, but it could present a more significant risk for the August report, given gasoline has a 3.4% weighting in the CPI report. Look, when gas goes up, the cost of goods that are being delivered typically follows, right? You got these truckers moving stuff, and it starts costing more to transport things, all of that. So depending on where the gas goes, if it keeps going like that, these next couple months could take a sharp knife in the stomach. So moving on, crude oil prices also rose sharply in July, almost 16%. That's huge. That was the most considerable 1 month oil price increase since January of 2022. Indeed, higher oil prices also can put upward pressure on inflation rates in the future. So it's not so much the today piece, it's the moving forward piece. As a result of gasoline and oil prices rising, markets now expect those impacts to be felt in the August and September reports. Due to these higher energy prices, headline inflation for August is expected to rise by 3.6% year over year and to 3.3% year over year in September, from previous estimates of 3.35% and 3.05%, respectively. Core is the bigger problem, but the real problem isn't changes in energy prices. It remains the core inflation rate that measures inflation ex food and energy. Core inflation has remained elevated partially due to shelter costs, but the other problem is that service inflation remains very high. At the end of June, service inflation was 6.15% year over year, while goods inflation was 1.3%. Both are much higher than their historical average from 2000 until the start of 2020 of 2.75% and 0%, respectively. Long-term rates may be too low. One problem is that long-term interest rates are too low given the core CPI based on the 30-year Treasury. Historically, the 30-year Treasury rate has traded above the core CPI inflation, sometimes by huge amounts. Based on the July estimates, the core CPI, the 30-year Treasury rate is about 60 basis points. For those that don't know basis points are kind of like a percentage of a percentage. So 60 basis points is like 0.6%. 60 basis points lower than, so 100 basis points is like 1%. So 60 basis points lower than the core CPI. It would seem natural to think that the more extended core CPI stay elevated, the more likely the 30-year Treasury rate and the entire yield curve will shift higher. Long-term rates mean that inflation may stay more persistent for longer. Additionally, not helping the matter is the financial conditions eased because rates are back on the yield curve fell following the SVB collapse. So when SVB collapsed. The easing of financial conditions has helped to recharge economic growth, which led to a stronger than expected second quarter GDP report and most likely the resurgence in energy prices as demand improved while also being aided by OPEC output cuts. But now that the data shows the improvement in the economy, rates have moved higher by a lot over the past few weeks and are now on par with the highs last seen in October. Again, the higher inflation stays, the more likely rates on the back of the curve are to trade higher. The more challenging it is for stocks, especially if higher rates lead to a stronger dollar and wider credit spreads causing financial conditions to tighten. The inflation fight isn't over. That's important. The inflation fight isn't over, and it could worsen, especially if oil and gasoline prices continue to rise as those costs filter through the economy and begin to feed into higher transportation costs and potentially goods and services. Which is what I said, right? More it costs to move things, the more it costs to buy things. Ultimately, this will mean that rates on the long end of the curve will have to continue to rise to account for the higher inflation rates. And more importantly, financial conditions will need to tighten and remain tight for some time, which means the party in the equity market isn't likely to persist and is probably already over. Let's see if there's anything else here. We use repeated and detailed process for watching the fundamentals, trends, technical charts, blah, blah, blah. All right, that concludes it. So the highlights here on that, kind of a summary. Analysts expect the July CPI to rise by 3.3% year over year and 0.3% month over month, with core CPI expected to rise by 4.8% year over year and 0.2% month over month. Rising gasoline and oil prices in July could lead to a hotter than expected CPI reading, potentially affecting August and September reports. Core inflation remains elevated, particularly in services, posing a challenge for the Fed and suggesting the need for higher long-term interest rates. That's it. All right. So that concludes it. Just wanted to drop that line and give you a little bit of insight on what may be happening here in the upcoming months with the CPI data, as it will affect COLA for 2024. The cost of living adjustment is coming up soon, and we're utilizing the numbers of July, August, and September. We're getting the July numbers here on August 10th, and then the middle of September we will get August numbers, and the middle of October we will get September's numbers, and then they will calculate the COLA, or cost of living adjustment, for all of us in that middle of October timeframe for the 2024 calendar year. All right. Thank you so much for watching. I really appreciate you. Have a great one. And remember, if we don't take care of each other, something went wrong.